Hello, everyone, and welcome to another webinar brought to you by OptionSlam.com. And here we go. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment or financial advice, nor do we make investment recommendations. All these webinars provided by OptionSlam.com are for educational purposes only. I am Marco. This is my email address. Today's discussion is in reference to earnings trades. In this series of webinars, which started 2 weeks ago, okay, we had a webinar a couple of weeks ago, which is kind of on the same theme. In this series of webinars, we are on a quest, and the quest is in evaluating different strategy styles. Last week, we evaluated directional versus non-directional strategies. Today, we're going to talk a lot about IV build versus IV crush strategies. In evaluating these different strategy styles, we are trying to learn, where is the edge in trading? Where can I find an edge where my strategy actually has benefits over other strategies, over all other strategies? That is our quest. This series will continue on because there's lots of things to compare. Again, last time we compared directional versus delta neutral, and today IV crush versus IV build. Breaking down strategy styles. Where is the edge? Directional versus non-directional. Well, we went into great detail on that. We learned that delta is the dominant Greek when discussing directional versus non-directional, also known as delta neutral. A position that is bullish has long deltas. We went into this in detail last week. I'm not going to do it again today. Refer to the previous webinar. If you don't have access to the previous webinar, shoot me an email and I'll provide you the link. OptionSlam.com@gmail.com. Otherwise, if you are a member, an insider member at OptionSlam.com, you have access to last week's webinar in the archives, found under the Resources tab. A position that is bullish has long deltas. A position that is bearish has short deltas. All that is explained in the previous webinar. Directional strategies win in one direction and lose in the other. Makes sense, right? That's common sense. If it's a directional strategy, it wins if you're right about direction, it loses if you're wrong about direction. We can think of this as less than 50% probability of profit. Let me just give you a quick example. If we jump over to, let's see, I happen to have Johnson & Johnson on here today. I think they took kind of a big hit today for some reason. I didn't look up the news, but maybe all healthcare, I'm not sure. But let's look at a quick example. What if we went in here out to the March monthlies and we bought a call, okay? So I just clicked on buying a call at the ask. I could probably get filled at a better price than that. The 157 at the money call, basically, slightly in the money, but regardless, here's my point. The risk profile, let me zoom in on this. Let me zoom in on this again. Okay, there's the risk profile. There's $290 at risk, and there's a break-even point up here. And if we were to hold this position all the way to expiration day, that represented by that blue line, That would be right there at break even, because why? The stock would have to go up from where it is now, up by $2.87 just to break even. So therefore, the probability of profit as illustrated and calculated by the thinkorswim software says that there's a 33% chance of profit above this line if you held this strategy all the way to expiration. There's a 67% probability that you would lose money if held to expiration. That's why I say we can think of this directional strategies having generally less than a 50% probability of profit. Now, I've introduced you to the risk reversal that greatly increases that to well over 50%. I've introduced you to the SWIC, the single winged iron condor, which also provides probabilities of profit as calculated by that same software, upwards of 90%. And, you know, there are directional strategies that I've taught you here in these webinars, but for the most part, this is the case, unless you use one of the more advanced techniques that I teach here at OptionSlam.com. So let's move on. Pros and cons. Now, this was a slide taken from the last webinar, and I'm not going to go through, yeah, sure, I'll go through it. I'll just go through it really quick. The pros and cons of directional strategies. Pros, they can have theoretically unlimited profit potential with certain strategies. Long call, long put, back spreads, and other strategies such as vertical spreads and others have limited profit potential but have lower risk. So these are just some strategy, directional strategies that are commonly used. The cons of directional strategies is you must be right about direction if using some of these more generic types of strategies. Can win only in one market direction, up or down, but not both and not sideways, as in a delta neutral strategy. Lower probability of profit, as I just illustrated with that long call in thinkorswim. Pros and cons of non-directional strategies. Pros, can win in any market condition, up, down, or sideways, which provides for a high or at least much higher probability of profit than most directional strategies. However, the cons are some can have unlimited risk if you're selling naked short options, such as straddles and strangles, and even the SWIC, the single winged iron condor that I mentioned earlier, has a naked component to it. And profits are limited. There are limits to profits, whereas certain directional strategies do offer the ability to have unlimited profits, but the likelihood of price going to the moon is low, right? So even though it's possible, it's unlikely that you're going to have, you know, huge winners. So let's move on. We concluded the edge is in delta neutral strategies for the reasons that I just mentioned. Delta neutral strategies over directional strategies, at least in my opinion. Some might argue and say, well, I can have one unlimited profit potential directional strategy, and if it does go to the moon, even though I know the chances of that are slim, I could pay for a lot of losing trades with that one huge winner. This is true, and I'm not gonna argue against that. The problem is it takes a mindset and a certain personality traits to be able to trade strategies that lose, 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 and then finally you hit a winner. It's a lot easier to trade mentally, psychologically, emotionally, when you have a strategy that wins more often than it loses. Winners are smaller than the occasional loser. Wouldn't it be nice if we had a strategy that not only wins more often than it loses, but it also, the winners are bigger than the losers? Imagine if you had a strategy that won 7 out of 10 times. All right? 7 winners, 3 losers, and the 7 winners were bigger than the losers. This would be a dream come true. Stick around. I will tell you about it. We can also talk about other comparisons. Directional versus non-directional. IV build versus IV crush. We're going to talk about that primarily from this slide on out today. We could talk about other things. Probability of profit versus return on investment. Risk versus reward ratios in various strategies. Defined risk versus undefined risk strategies. We could do a whole webinar just on that topic. We could do a webinar like we're going to do today on IV crush versus IV build strategies. Implied move trading setups. We've talked a lot about implied move, and I believe it's critically important to be aware of the implied move as you are designing the strategy that you wish to employ. Optionslam.com and gmail.com. Dan, optionslam.com at gmail.com. Please feel free to email me. Today, our quest for the edge first leads us to the IV crush versus IV build comparisons. So let's get into it. Earnings brings implied volatility into your options premium. Does everyone understand that? As we approach an earnings event, implied volatility creeps in to our options values. If you look at any value of any option, we just had one on the screen. Okay, let me go back to that one quick a minute. Okay, so here's an option that I just very randomly picked out of the option chain. It is the 157.50 call on Johnson & Johnson that expires on March 15th. Now, when is Johnson & Johnson? I don't think, when are they? They're going to have an earnings report coming up soon. I think in about a month and a half or so, or a month or so. Let's jump over here to 3-year weekly. I could go to OptionsSlam and find out exactly when. Here it is, right here on Thinkorswim, April 16th. So as we approach, let me go back to the, I'll go back to a 2-year. Do I have a 2-year daily? On my live program, I do. Here we go. So here we are today. As we approach this earnings event that's confirmed for April 16th, 2024, implied volatility will increase. As implied volatility increases, it will tend to increase option premium. But that's not the only thing that controls option premium, is it? So stick with me. Earnings is synonymous with implied volatility. Its IV is that component of an options premium which is associated with the Greek known as vega. Okay, it's really important. And it's not a difficult concept. Some people have trouble understanding vega. I hope that I'm going to make it really simple for you today. IV is not a component of stock. IV is something that's specific to options. Stock couldn't care whether implied volatility is going up, down, or whether it exists at all. It does not, implied volatility does not affect the price of the stock, but it does have a major price, a major effect on stock, it has no effect on stock pricing, but it has a major effect on options premium. So as IV changes, options premiums are affected. As a stock approaches its earnings release date, implied volatility increases. Implied volatility is a major component found in all options pricing models, such as Black-Scholes, such as Jerkslin-Stensland. I always say that one wrong. What is Vega? It is related to implied volatility. It is the measurement of how your option premium will change based on a change in implied volatility. I like to say that Vega implied, let me say it the way I like to say it. Implied volatility is to Vega as stock price is to delta. So again, we talked about delta in the last webinar. I'm not going to get into that Greek so much today. So let me say it again. Vega is to implied volatility like delta is to stock price. Quickly, stock price goes up $1, and if you own stock, let's say you own 100 shares of stock, or if you want to keep it really simple, you own 1 share of stock. If the stock goes up $1, if you own the stock, stock has 100 deltas. So if the stock goes up $1, you're gonna make $1. All right, Vega is the measurement of an options price sensitivity to changes in the volatility of the underlying asset. So this is a definition copied out of, I think, probably Wikipedia or Investopedia. I forget where I copied this out of. Vega is the measurement of an options price sensitivity to changes in the volatility of the underlying asset. Vega, again, the asset itself does not have an implied volatility. So I'm not quite 100% comfortable with this definition. But the options chain and all the options of an underlying asset do have implied volatility. Every option has its own implied volatility. Vega represents the amount of an option contract's price changes in reaction to a 1% change in the implied volatility of the underlying asset. So just like delta, for every $1 move in the stock, whatever your option delta is tells you how much your premium is going to change. Just like that, Vega tells you that a 1% change in the implied volatility is how much your premium is going to change. The Vega associated with an option tells you how much your option premium will change if IV increases by 1%, by 1 percentage point. When you buy options, you are said to be long Vega. When you buy options, you are said to be long Vega. When you sell options, you are said to be short Vega. Let's go back to that chain, that options chain, and let's take a quick look. So here you see, I have, let me get rid of a couple things here. Customize this to make it a little easier to read. We don't need extrinsic. We'll remove that item, and we don't need mark. We'll remove that item. Okay, so now we got delta, gamma, theta, Vega. So if you, this stock, okay, so I'm going to compare delta and Vegas just so that there's a hopefully this makes it easier to understand. If you buy this 157.50 call, you're going to have a delta. Let's follow that over here of, it's holding a delta of 61. It has a gamma of 8. Okay, we're just going to ignore the gamma factor right now. I'll teach more about that in an upcoming webinar. And it has a vega of 11. Now, if the stock goes up in price, your option is going to increase in value. This 157.50 option is going to increase in value from 283, and it's going to go up by 62 cents. It's going to become worth $3.46. I think I did that math almost correctly in my head. Not sure. Like I like to say, I'm really good at math in my head, except when I'm talking. I can't chew gum very well either at the same time. So anyway, so that's the delta factor. If the stock price goes up a buck, my option is going to go up by a 62 delta. It's going to go up 62 cents. But now let's talk about vega. If implied volatility goes up, and what do you mean implied volatility goes up, Marco? Well, look at this chart over here. Do you see this on the bottom? I see this implied volatility. You see this implied volatility chart? You see implied volatility going up, and then it comes down, and then it goes up, and then it comes down, and it goes up, and it comes down. And you'll see that across all stocks as implied volatility changes. But let's go back to the options chain. If implied volatility goes up 1 point, my long call is going to go up in value by 11 cents. 291 is the value of the option right now. If implied volatility goes up 1 percentage point, my option premium is going to go up to, what would that be? 290 plus 11 cents is going to be 301, okay? 301 on the ask. All right, does that help clear it up? It's not that complicated. So there's the explanation for what is vega. Let's move on. If you buy options, you are long vega. In other words, you have positive vega in your position, and you want implied volatility to come in because that's going to help the value of your premium of the option you own. If you sell options, you are said to be short vega. You would like to have implied volatility go down, thereby decreasing the value of the option that you're short so that you could buy that option back cheaper than you sold it. Make sense? Any questions are welcome in the chat box there. Dan asks, how far in advance of earnings does IV start to build? Well, it's kind of, have you ever seen a theta curve, Dan, where theta increases as you approach the expiration date of the option? And theta, you know, if you are long an option, let's say you're long that this option, and this expires March 15th, 11 days from now. It currently has a theta of 10. Well, theta is not a straight line. It's not going to be 10 every day from now until options expiration. It's going to increase. That theta means your time decay is going to have it's going to get larger and larger, and it's going to decrease and eat away at your option premium faster and harder the closer you get to the expiration date. Well, to answer your question, the same is true. And again, Dan's question is, how far in advance of earnings does IV start to build? The answer is, it starts to build many weeks before the earnings event. Many weeks before the earnings event. And but it does so on a curve up. The opposite of that downsloping curve in a theta curve that we often see in a graph. I don't have one. I mean, I have one handy, but I don't want to take the time to go look at that. Okay. I could probably show it. But anyway, let me just finish answering the question so I can get back to the presentation. And so it starts building many weeks in advance. Let's say 6, 8 weeks in advance. And there's a lot of other factors that come into play here as to when. For example, one factor is, when does the company confirm its earnings event? Because most companies don't confirm their earnings event until about 2-3 weeks before the earnings. So, therefore there are some caveats, but it's on the curve. It starts building very slowly, 8 weeks before, let's say, and then the closer and closer you get to the earnings event, the more implied volatility is building into the options premiums. IV crushes once the earnings news is out. The implied volatility built into an options premium over that period of time that we were just talking about, slowly but surely and increasingly so as we approach the earnings event, that options premium that has been building, and IV, I should say, that has been building, deteriorates quickly and substantially immediately after the earnings release. This is true for both puts and calls. Both puts and calls are affected by IV crush, what we call IV crush. There are many IV crush plays that we hear about and that we teach about here at optionslam.com, revolving around the earnings events. They are premium selling plays. Primarily, they are premium selling plays. Now, they might be hedged. You might have some long premium and some short premium, but the dominant net result is you are short premium, there you are short volatility, therefore you are putting on a trade that you're going to hold through the earnings event, for example, and you are going to benefit from the earnings crush, from the IV crush, I should say. These plays are known as short vega. When you are short premium, you are also short vega. When you are long premium, in other words, you bought an option, you are long vega. Many earnings strategies benefit from IV crush, especially those that you initiate the trade before the earnings when IV is high, and then you hold the trade, your strategy, your position through the earnings event and experience the IV crush, and your strategy has a beneficial effect. The effects are beneficial to your position. Many earning strategies benefit from IV crush. Therefore, many traders design an option strategy that is short vega so that the IV crush becomes their ally. But before IV can crush, it must first build. Because, well, I'll explain in the next slide. Yet we rarely hear about strategies that are designed around IV build, building into the earnings event. We rarely hear about that. Strategies that benefit from short vega, we're going to talk more about long vega trades in a moment, but let's continue this topic on this topic. Strategies that benefit from short vega, that's when IV crushes at ERs. These are strategies that you could put on right before an earnings event, and there are more. It's not just these, and there's always the varieties of putting these strategies on and hedging them, spreading them, etc. But short call, short put, short straddle, short strangle, short verticals, all of these benefit. Now, there's other factors. I'm going to talk about more about that. These all are beneficiaries of IV crush. However, doesn't make them all winners, because other forces are in action. Iron condor, very common pre earnings strategy or through the earnings strategy. I like to call it. I like to think of earnings trades as pre-earning strategies. That's strategies that you put on before the earnings and get out before the earnings event. And then through the earnings event strategy is the second type. That's the kind you put on before the earnings, but you hold through the earnings event and get out sometime after. And then there's post-earnings strategies where you wait for the earnings event. You totally avoid the wild price swings that earnings events can cause. And then you do some kind of an approach that either looks for expansion of that move or a fading of that move. So three types of earnings trades: pre-earnings, through earnings, post-earnings. Iron butterflies, another beneficiary of the IV crush. Short back ratio, also known as a front ratio. Most butterflies, most other regular butterflies, all calls, all puts, depending on, you can do broken wing butterflies, ratio butterflies, a combination of a broken wing that's also ratio. I mean, would it be possible to create a butterfly that does not benefit from IV crush? I've never tried, but I would imagine that that's possible. But most other butterflies also benefit from IV crush. IV must first build, though, before it can crush. IV fluctuates within a range as option contracts are created. Let's jump back over to, let's do a different stock. Let's go something that's got, let's do something that's got a higher EVR. Earnings volatility rating is something that we do at optionslam.com. We rate every stock for how volatile, not IV volatile, not implied volatility volatile, but instead how historically volatile the stock is as a reaction to its earnings event. That's what EVR is. It's exclusive to optionslam.com. It's the only place you can find it. And then stocks that are high EVR stocks are also stocks that have a high implied volatility build. Now, this implied volatility, I need to explain something quick on the side. I'm sorry, I'm going off on a tangent here. It's a bad habit, but I need to illustrate something. You see IV building here on Netflix up to what? The earnings event, and then IV crushes. This IV crush is a pretty accurate picture. This IV build is not. Why is it not accurate? Well, it's not accurate in my mind because the formula used to create this particular implied volatility study or metric or this implied volatility indicator, whatever you want to call it, the formula used is looking at many, many different expiration cycles. Some front week weeklies, some further out monthlies, and some option contracts that are quite a ways out in time, up to 2 or 3 months away. If you look at an options chain of Netflix, let's see who's got earnings coming up this week. This might here we go. CRWD's got earnings coming up in just a couple of days. So I'm going to just show you two different implied right here, both inside of Thinkorswim. Look at the implied volatility using the formula that is specific to an options expiration week. Okay, this is a implied volatility that is specific to the options that expire this coming Friday. Here is the implied volatility for the options that expire March 15th. A formula is created because each and every one of these options has its own implied volatility. Okay? What they do is they grab a whole bunch of these options and they use some formula that they won't tell us exactly what that formula is. And your broker might have a different IV. Let me just add, let me go to layout and customize this, and let's add IV so that you can see that I'm not teasing you. Every option has its own implied volatility. So here's, I just added the implied volatility column, and you can see that the 315 calls have a 98.68 IV. So why do they say that the IV of the options is 99.76? Well, it's because it's taking that 98, whatever it was, that it's taking that, and it's taking a bunch of these other IVs, and it's somehow using some formula that they won't divulge to us. And it's grouping them all together, applying the formula, grabbing this IV and that IV from all these different options, and saying the options that expire on this day, March 15th, have an IV in, we'll just call it an average, let's call it an average IV of 99.76. It's not truly an average, but it's, all right, so I wanted to explain that and now if you understand that, let's go to this IV. Look at this IV. You see that this IV is not the same. It's not, but once again, let me shorten this up. You see that these options that are further out in time, like a couple months from now, are at much lower IVs than the options that expire this Friday. If we look at it here in this IV, this is a different formula than the formula that gives an IV for each and every expiration cycle. It's all I wanted to make clear to you guys, okay? So the IV doesn't build in any specific one options expiration cycle the same way that this chart illustrates. This chart illustrates IV build of multiple expiration cycles averaged through a formula. So they are different, okay? As implied, as we approach CrowdStrike's earnings event coming up in tomorrow after the close, IV is likely to increase, but this chart shows that it hasn't really increased much in the last 2 weeks. Well, that is dead wrong if you are looking at a certain specific expiration cycle. Okay, this chart is not, enough on that. Let me go back to my PowerPoint. I get off on tangents, and man, shame on me. Let me go back to this now. IV fluctuates within a range. As options contracts are created and expire through the life cycle of a stock. So the chart IV study kind of illustrates this better than looking at the options chain showing all of the different options expiration cycle implied volatility. Stocks have a variety of IV ranges. A low beta, like I had on the screen earlier with Johnson & Johnson, and a low earnings volatility rated stock have IV ranges that hover around 20. They hover around 20. They live within a cycle, a range cycle that might have a low around 15 and the lows at the lows and 25 at the highs. Johnson & Johnson would fall into that category. However, stocks with a slightly elevated beta and higher EVRs might have IV ranges that hover around 40, with a range from 30 at the lows to 50 at the highs. And stocks like Netflix are going to be high beta stocks, high EVR stocks. They may have IV ranges that hover around 60, with a range from 40 at the lows to 70 at the highs. And these higher beta stocks, these higher EVR stocks, their high end of their range can go much higher, even if they're hovering around 60 for other than at earnings, when they get to earnings, like CrowdStrike, they could be at 90 or 120. Let's quick look back again. With this formula, you see IV, let's go back here. IV builds and then it crushes. See, this is not super representative of when it crushes, because this is representing a whole bunch of different expiration cycles. So they're not all crushing at the same rate. Okay, IV builds, come to the earnings, and it crushes. IV builds, come to the earnings, and tomorrow after the close, or Wednesday morning, you will see this will have a huge spike down. Okay, so IV range depends on the stock's earnings volatility rating. Lower EVR stocks are going to have lower ranges. Let me go back again. Sorry, but I want to make this clear. Here's CRWD. Let's go back to the options chain. Who's a low volatility stock? Oh shoot, I should have opened up Option Slam and found a low volatility stock, a low EVR stock. I don't want to take the time. We're running out of time already here. Maybe at the end if we have time. So Nick, that's kind of a more sophisticated question. And how does IV building and crushing affect the Vega? Vega has a direct relationship to how far away is the expiration cycle. Stocks that are further out in time have higher Vega. Stocks that are closer to the at the money strike, let's go look at, for example, let's go look at, okay, we're in crowd here. We're in crowd right here, right now. And we got Vega on here. You can see that as we move away from the at the money, the Vega goes down. When we get, when price is close, when we look at the Vega of options that are close to the price of the stock, that is when Vega is at its highest. And then we move away. It doesn't matter which direction, whether we move up in price, away, out of the money options, or in the money options. When we move away from where the stock is trading, Vega gets lower. It has less of an effect on your options premium. It has the most highest effect on options that are closer to the money. True on both the calls and the puts. One more thing to answer your question is further out in time. So what option were we just looking at? Let's look at the at the money. Let's see. Let's look at the front week weekly. At the monies, let me change this to just 10 contracts so that it's easier to scroll. Okay, so so the very short dated options with only 4 days left to expire, the at the money highest Vega is around 13. It looks like they're all 13, but that's because I scrunched it down to only showing 10 options, and these are very short dated options, so they're going to be very close. But let's go out in time to 46 days, and the further out in time you go, look at what happens to the Vega. It gets bigger. So longer dated options, those options that have more time till they expire, have higher Vegas, and options that are closer to the money, to where the stock is trading, have the higher Vegas. Okay, so I could go on and on about that, but we need to get back to the topic of today, and that is, let's move on. As we approach an earnings release date, implied volatility grows from the low end of the range to the high end of the range. Again, I'm going to refer back to this implied volatility. IV fluctuates in a range on this stock. You can see the high end of the range is right now, where we are right now today. We are at a very high end of the range, the highest that we've seen in a year. Here's the low end of the range, which is around 30. Mid-range seems to be, what, about 45. Okay, I'm reading the numbers over here. And then the range is like 30 to 70, with the midpoint maybe around 40. It's debatable, whatever you want to call the midpoint of this, the normal range, if you will. If IV increases, this will benefit your position. Don't get overconfident just about implied volatility building, though, because though implied volatility is a critical component of options pricing models such as Black and Scholes and Strensland. I probably didn't do those names justice again. There are other forces at work. Just because our option position is long Vega and we are approaching an earnings event, therefore we are expecting implied volatility to increase, and we are long Vega, we're long a call, we're long a put, we're long a non-directional strategy, we're long a straddle, for example, which we intend to close before the earnings event. We buy the straddle, let's say, a week before the earnings event. This is a valid strategy. Works great on many stocks. I think we have lots of webinars in our archives about this strategy. Buying a straddle before earnings and closing it before earnings. Buying a straddle a week or so before earnings and closing the trade before earnings. You can count on IV, for example. In that example, you can count on IV to increase. Will it make your trade profitable? Not necessarily, because if the stock doesn't move enough and there is no delta change in your underlying position, and time goes by and theta deteriorates and eats away at your position, you are not guaranteed to have a winning position just because you bought a straddle before earnings. You need that delta component. So what the IV does in this example that I'm verbalizing now of a long straddle, picture it. You appreciate IV increasing because it's supporting your options premium. You own a call and a put. However, theta is eating away. Is the IV increase and Vega working for you enough to offset the theta decay? Usually not. Okay? Usually not. I can illustrate that right at optionslam.com in one of the charts, but again, hurting for time, so we need to move on. You also, with that strategy, buying a long straddle, you also not only want IV to build, because that's going to help offset the theta decay in your long options. You not only want the IV to build, but you need delta. You need a delta move. You need the stock to go somewhere. You don't care if it's up or down, but you need it to move sufficiently. So you got IV working for you, you need delta working for you, and those two together can well offset the theta decay, making it a viable position. We've done lots of studies on them. You'd have to dig back in the archives, at the webinars archives. I can do another study on it. I've got a study I'm working on right now that I'm going to bring to you at optionslam.com that is very similar to a long straddle, but it's not a pre-earnings trade. It's a through the earnings trade. It's looking for a huge move. But enough about that. Sorry, another tangent. For example, if we own options in a bearish position and the stock goes up, the IV increase will not be enough to offset the loss of premium due to delta and theta. Didn't I just say that? I sure did. Let's go move on. Strategies that benefit from long vega or IV build into ER. And then I'm trying to drive this point home. This is tough because even though if we're looking for strategies that will appreciate positions that will profit from IV building into an earnings release event, you don't hear these talked about very often. They're pretty rare. This is tough, I say, because even though we know IV is going to build, we've seen it on the charts, we've seen it in the studies. As we approach the earnings release event, this should increase the value of our long options due to the vega factor. However, there are other forces at work. Primarily, theta is eating away at premium values every day, and increasingly so as the days get closer and closer to the earnings event. But more importantly, with theta, as time gets closer and closer to the expiration date of those options. That's the theta curve. And if you are in a directional strategy, delta can be your friend, but delta can also be your foe. Remember, if you are in a directional strategy, you need the price of the stock to go in the right direction. You're either bullish or you're bearish. So, moving on. What are some strategies that can benefit from long vega or IV build? Well, again, remember the caveat. Here's a list of some strategies, not all, but most of the most common ones that do benefit from long vega or implied volatility build as we approach an earnings release. Long call, long put, long straddle, long strangle, long calendar, basically long premium trades, long diagonal, long vertical spread, and long back ratio. And there are more. But there is that same caveat that I want to keep driving home. However, with most all the strategies listed on the previous slide, being long vega is not enough to make them profitable in and of itself. It is just one component of your options that helps support your premium in your options, which is hopefully, well, it is. It's offsetting the theta decay. The time decay is eating away at your options. The IV build is improving the price of your options, but not quite enough to offset theta completely. Usually, there are some cases, and if you remind me in a future webinar, I can show you how you can find those right at optionslam.com. So, as mentioned, we can count on IV build to help our long positions value, but IV alone will rarely overcome delta and theta. Is all hope lost in finding a strategy that I should have combined those slides. What if you could find a strategy that has an excellent win rate with a high probability of profit? Wins whether stock goes up, down, or sideways within limits. A delta neutral approach. What if you could find a strategy that has an excellent risk to reward ratio? A strategy that you are out of the position with your profits before the earnings, thereby avoiding the unpredictable wild price swings at earnings. An option strategy that takes full advantage of the implied volatility building into an earnings event. A strategy that works in all market conditions, bull, bear, or otherwise. A strategy that has defined risk. You will be able to sleep at night. It's not going to kill you if it once in a while loses some money. And you know how much money you have at risk because it is a defined risk strategy as opposed to an undefined risk strategy. And if you have registered for the webinar tomorrow night, I will be talking about the doubleeagleworkshop.com. And if you go to this URL, let me just go there now for you. Easy to remember, webinar.doubleeagleworkshop.com, okay? This will take you to a page that has that link into it, and if you have not already registered, you can learn more about the Double Eagle tomorrow evening. And I have a workshop coming up starting this coming Saturday to teach about the Double Eagle. And you should have already got an invitation to that webinar that is tomorrow. And these links will take you to a place where you can register for that webinar in case you haven't already. Let me see, let me go back to that page. So this is webinar.doubleeagleworkshop.com, and tomorrow night's presentation is a sales pitch for the workshop that starts this coming Saturday and will go on for 7 weeks. It's a long, involved, intense workshop, and I'm out of time. So that's all I can say. Come to the webinar tomorrow night to learn more about the Double Eagle, to find a strategy that does all of these things. Excellent win rate, high probability of profit, wins in all market directions, up, down, or sideways. Excellent risk reward ratio. This is my strategy. I can't say that I invented it, but I can say that I perfected it. Me and my team, the team of traders. We have a community of traders that we work together. And over the years, I started teaching this strategy back in 2015. Over the years, we have perfected the Double Eagle. Hope to see you there tomorrow night. Webinar.doubleeagleworkshop.com. Goodbye for now, and wishing you all good trading.